The question every real estate investor is asking right now isn't whether to invest. It's times where, and more importantly, how. Because the strategy you pick could be the difference between building wealth and bleeding cash in this market. We're living through one of the strangest moments in real estate history, where mortgage rates are sitting at levels not seen since the early 2000s, and yet prices in certain metros refuse to budge. The tension between those two forces, stubborn prices and expensive debt, is quietly sorting investors into two camps: those still buying and holding, and those who've pivoted hard into the BRRRR method. For anyone who needs a quick refresher, BRRRR stands for buy, rehab, rent, refinance, repeat, and the core idea is that you force equity through renovation rather than waiting for the market to hand it to you. Think of it like buying a diamond in the rough, polishing it yourself, and then convincing the bank that it was always worth more, because now, with the right numbers, it actually is. The buy and hold crowd used to have the wind at their backs when rates were sitting near 3%, and appreciation was practically automatic in cities like Phoenix, Austin, and Boise. But those same markets that looked like golden tickets in 2020 and 2021 now have cap rates so compressed that positive cash flow is basically a myth without a serious down payment. The headlines that once screamed hottest real estate market in America have gone oddly quiet. Psychologically, this is where a lot of investors start to crack. They see the strategy that worked for their mentor or their podcast hero slowly stop performing, and doubt creeps in. But here's what the most grounded investors will tell you. The strategy didn't break. The market context shifted, and your job is to shift with it, not panic. History has a sense of humor in real estate. Every cycle feels unprecedented until you zoom out and realize we've done this dance before. The savings and loan crisis of the 1980s, the dot-com crash spillover in the early 2000s, the 2008 collapse, each one felt like the end of the world, and each one quietly minted a new generation of disciplined investors who bought when everyone else was frozen. So where does BRRRR actually shine right now? And why does it beat passive buy and hold in specific environments? The answer comes down to one concept: manufactured equity, which works best in markets where prices are still relatively low, labor costs are manageable, and rents have climbed faster than home values. Midwest cities like Cleveland, Detroit, Kansas City, and Indianapolis are checking almost every one of those boxes simultaneously. A common misconception is that BRRRR is just flipping with extra steps, but that's like saying a chess match is just checkers with fancier pieces. BRRRR is a long-term wealth accumulation system that uses short-term effort to extract capital that would otherwise sit dormant in an underperforming asset. In contrast, buy and hold still makes enormous sense in high appreciation markets where your equity growth is doing the heavy lifting even if monthly cash flow is thin. Think certain pockets of Nashville, Charlotte, or the Research Triangle in North Carolina. The key lesson history keeps teaching us, and we keep forgetting, is that no single strategy dominates every market, every cycle, every time. The best investors are bilingual, fluent in both approaches. From a practical standpoint, if you're evaluating a market for BRRRR, you want to see after repair values that support a refinance covering at least 70 to 75% of your total project cost, and rents that clear your debt service with room to breathe. If you can't pencil that out on a spreadsheet before you ever visit the property, no amount of optimism is going to save you at closing. Here's the part nobody puts on their motivational Instagram post. Discipline is boring, and boring is profitable. Sizing your deals conservatively, maintaining cash reserves, and not over-leveraging your refinance just because the appraiser gave you a number you like. That's the actual strategy. And it applies whether you're in Memphis or Milwaukee. The investors who will look back on this period of high rates and market uncertainty with satisfaction aren't the ones who made the boldest bets. They're the ones who did the math repeatedly, stayed patient, and acted when the numbers genuinely worked. Conviction without calculation is just expensive hope. At the philosophical level, real estate rewards those who understand that they're not just buying properties, they're building systems, and systems require consistency far more than they require perfect timing. Whether the market goes sideways for another 2 years or rates drop suddenly and demand explodes, the investor with a disciplined process is positioned for either outcome. The beauty of mastering your entry criteria now in a difficult environment is that When conditions ease, you won't just survive, you'll accelerate. Because your habits were built under pressure and not under perfect conditions. And honestly, there's something deeply comforting about knowing your strategy doesn't depend on the market cooperating. It just depends on you executing. Whether you're trying to figure out which market fits your BRRRR criteria, find trustworthy contractors for your rehab, or connect with lenders who actually understand investor financing, check out the links in the description below and let us help you get started.